You think being smart is an advantage in this market? That the sharper your analysis, the safer your money. That's what you were taught your whole life. Study harder, think clearer, win bigger. Here's what nobody tells you. I built 4 fortunes in my life, and I lost every single one of them. Not because I didn't understand what I was doing, because I understood it perfectly, and my intelligence talked me out of following it anyway. That's the cruelest thing about this game. It doesn't punish stupidity the way you'd expect. It punishes conviction. The smarter you are, the more convincing the story you can tell yourself for why this trade, this time, is the exception. Intelligence doesn't stop you from breaking your rules. It's the thing that gives you permission to. By the end of this, you'll understand why the mediocre trader who follows a simple system without question will consistently outperform the genius who keeps finding brilliant reasons to deviate from his. And you'll understand exactly what to do about it, so your own intelligence stops being the most expensive thing you own. I learned this the hard way, 4 times over, before I ever learned it for good. You don't have to. This is Trader's Bible, the quiet room for market mastery. Let's get into it. Let's start with the moment the poison first enters your bloodstream, because for almost every intelligent trader, it enters exactly the same way, and almost nobody recognizes it while it's happening. It's the impossible prediction. You make a call that shouldn't be possible to make. Not a lucky guess. A real, complex read on the market, built from genuine analysis, and it plays out exactly the way you said it would, to the point. Maybe it's a single trade. Maybe it's a call you made out loud, in front of people who've been doing this longer than you, and you watch their expression change when it comes true. That moment feels like validation. It is not validation. It's the first domino. I remember mine with more clarity than I remember trades I made last year. I was barely past being a teenager, working in an office full of men who'd survived panics I'd only read about in newspapers, and I called a railroad stock's move to the exact point. Not roughly, exactly, and I watched something happen in the way those older men looked at me afterward. It wasn't respect exactly, it was something closer to unease, like they'd just watched something they didn't fully understand. And I felt, for the first time, inevitable, not lucky. Inevitable. Like the market had personally chosen to show me something it kept hidden from everyone else in that room. Here's why that feeling is so dangerous, and why it has nothing to do with how accurate the prediction actually was. A correct, complex forecast is the single most convincing evidence a trader will ever encounter that they've cracked something fundamental. And it's almost always wrong to draw that conclusion, no matter how right the prediction turned out to be. One accurate call, even a brilliant one, is a data point. Your mind doesn't process it as a data point. It processes it as proof of identity. You stop being a person who made a good call and start becoming a person who sees what others can't. That shift in self-concept, not the trade itself, is the actual event that matters, because everything that follows gets filtered through it. This is where traders misuse the moment without ever realizing they're misusing it. They take a genuinely impressive, statistically rare win, and instead of filing it away as exactly that, rare, they use it to recalibrate their entire relationship with risk. The stop losses that used to feel necessary start to feel like they're for other people, people who don't see the market the way you do now. The position sizing that used to feel appropriately cautious starts to feel timid, almost insulting to the insight you just proved you had. Nothing about your actual skill changed between the moment before that prediction and the moment after it, but your risk habits changed completely, quietly, without your permission, because your ego renegotiated the terms while you weren't looking. I want you to hear this plainly, because it's the reframe that would have saved me more money than any strategy I ever built. A wildly accurate prediction is not proof that you've solved the market. It's a statistical anomaly, and anomalies, by definition, don't repeat on command. The correct response to nailing an impossible call isn't to raise your conviction going forward. It's to actively reset it. To treat the win the way a disciplined scientist treats an outlier result, with more scrutiny, not less, precisely because it's the result most likely to distort everything that comes after it. The traders who survive the impossible prediction are the ones who consciously refuse to let it change their baseline. The ones who don't survive it are the ones who let it become the foundation of a new, much more dangerous identity. The identity of someone the market has personally chosen to favor, because that identity doesn't stay quiet for long. It starts demanding permission to act on its own certainty, and that permission has a name. The illusion of the intelligent exception is what happens next, and if the impossible prediction is the poison entering your bloodstream, this is the poison finding a vein. Here's the mechanism, stated as plainly as I can state it. You build a system, a real one, with clear entry signals, clear exit signals, clear rules for what wrong looks like. And for a while, you follow it, because you built it in a calm state, with a clear head, without money actively riding on the outcome. Then, one day, you're watching a position, and your analytical mind, the same mind that built the system in the first place, starts noticing something the system didn't account for. A nuance, an angle, a piece of context that feels too specific, too insightful, to ignore just because a predetermined rule says to. And that's the exact moment intelligence stops being an asset and starts being a liability, because it gives you a permission slip that no average trader would have thought to write for themselves. This is what I mean when I say intelligence becomes an excuse for impatience. A trader without much analytical horsepower, watching a stock move before their system triggers, doesn't have the tools to construct a sophisticated reason to jump in early. They either wait or they don't, and if they don't, it's usually obvious even to them that they were just impatient. But an intelligent trader watching that same setup can build an entire, coherent, technically plausible case for why this particular instance is the exception, why waiting for the signal here would mean missing the move, why their deeper understanding of the situation justifies front-running their own rules. It doesn't feel like impatience from the inside. It feels like insight. That's precisely what makes it so much more dangerous than ordinary impatience. It arrives wearing the exact costume that's supposed to signal trustworthiness. I lived this pattern for years before I could even name it. I'd see a stock beginning to move, and instead of waiting for my own signals to confirm it, I'd think, I understand what's happening here. I can already see where this is going. Why would I wait for confirmation I don't actually need? And I want to be precise about what that sentence really was underneath the surface. It wasn't analysis. It was impatience, fully dressed up in analytical language, and dressed up so convincingly that I believed it every single time. Here's how you actually defend against this. Because just knowing the trap exists isn't enough. I knew it existed for years and fell into it anyway. You need an explicit circuit breaker built into your process, something mechanical enough that it doesn't require you to out-argue your own intelligence in the moment, because you will lose that argument nearly every time. The moment you notice your mind constructing a reason to move a stop, enter early, or skip a confirmation step, that thought itself needs to be flagged. Not evaluated on its logical merits, just flagged. As an emotional impulse wearing an intellectual disguise. You don't debate it, you don't weigh its evidence. You simply recognize the pattern and refuse to act on it. The same way you'd refuse to act on an urge you already know, from experience, tends to be wrong, 9 times out of 10, regardless of how right it feels in the moment. The reframe that matters here is this. The mediocre trader who executes a mediocre, simple system with total obedience will beat the brilliant trader who keeps discovering brilliant reasons to override their own excellent system, every single time, over a long enough run. Not because the mediocre trader's edge is better, because their edge actually gets executed, trade after trade, while the brilliant trader's edge gets quietly sabotaged by its own owner, one clever exception at a time. And once you understand how exceptions get justified in the moment, you're ready for something even more dangerous. Because it's not just impulsive exceptions that destroy intelligent traders. It's the beautiful, patient, fully reasoned stories they build to justify staying in a position that's already bleeding them. Smart people are dangerous storytellers, and this is the trap that has probably cost more brilliant traders their entire accounts than any other single pattern I've witnessed, myself included. Here's what's actually happening when this trap sets in. Intelligence, by its nature, takes scattered data and weaves it into coherent explanations. That's not a flaw. It's the exact skill that makes intelligent people good at almost everything else in life. In school, in business, in most of the world, the ability to construct a compelling, well-reasoned narrative out of complicated information is rewarded constantly. It's how you get promoted. It's how you win arguments. It's how you build a reputation as someone whose judgment can be trusted. The market is the one arena where that exact skill becomes a liability, because the market doesn't care how coherent your story is. It only cares what price is actually doing. Picture the moment this trap closes. You're holding a position, and it starts moving against you. Not catastrophically, just enough to feel uncomfortable. And your intelligent mind, doing exactly what it's built to do, starts constructing an explanation for why this doesn't actually contradict your thesis. The fundamentals haven't changed. This is just temporary volatility. The crowd is mispricing this, and they'll come around once the data catches up. Smart money knows to sit through moves like this. Every sentence in that story might be completely true. That's what makes this trap so much more dangerous than ordinary denial. The narrative isn't a lie you're telling yourself. It's often genuinely sound reasoning, built on real analysis. And that soundness is exactly why you trust it more than you trust the ugly, simple fact sitting right in front of you on the chart. The position is losing money, and it's continuing to lose money while you wait for the story to be validated. This is where I have to tell you something that took me 4 separate fortunes to actually absorb. The market can stay irrational, or simply disagree with your correct thesis, for far longer than your account can survive the disagreement. I've said that sentence to other traders more times than I can count, and I watched most of them nod along and then go do the exact thing the sentence warns against, because agreeing with an idea intellectually and actually obeying it while your capital is on the line are 2 entirely different acts. Your brilliant thesis about where a stock should be going is worth exactly nothing if the actual price action is telling you something different right now. The market doesn't grade essays, it only settles positions. The application here requires a genuine identity shift, not just a rule. You have to stop operating primarily as a predictor and start operating primarily as a reactor. A predictor asks, what should happen based on everything I understand? A reactor asks, what is actually happening, right now, regardless of what I understand? Those 2 questions can point in completely opposite directions, and when they do, only one of them has money attached to the correct answer. When a structural level breaks, the level you defined, in advance, as the point where your thesis is proven wrong, you liquidate. Not because your story might be false. It might be entirely true. You liquidate because the story, true or false, brilliant or shallow, has no bearing on what price is doing to your account balance while you continue holding. Before we go further into this, and honestly, what's coming next is the piece that ties everything together, the actual mechanical solution to everything I've described so far. If any of this is landing for you, take a second to subscribe to this channel and turn on notifications. I say this because the next few points build directly on top of everything we've just covered, and I don't want you catching this framework in fragments across 6 months of the algorithm deciding whether to show you the rest. All right, let's keep going. Everything up to this point has described the disease. What comes next is the actual structural cure, and it's the single most important reframe in this entire video. Bipolar operational identity, the architect versus the soldier, is the concept that finally made all of this survivable for me. And I mean that literally, not as a figure of speech. Here's the core idea, and I want to state it as cleanly as I can, because everything else in this framework depends on understanding this distinction correctly. Trading isn't one activity performed by one version of yourself. It's 2 entirely separate activities, performed by 2 entirely separate versions of yourself, and the single most common mistake intelligent traders make is letting those 2 versions bleed into each other. There's the architect, the version of you doing research, building strategy, developing rules, studying market structure, using every ounce of analytical horsepower you possess. And there's the soldier, the version of you executing a live position, with real money exposed, who has exactly one job: follow the plan the architect already built, without negotiation. The mistake, almost universally, is letting the architect show up while the soldier is supposed to be working. You're in a live position, money is actually on the line, your pulse is elevated, and suddenly your analytical mind wants back in the room. It wants to tinker. It wants to reconsider the stop level given new information. It wants to optimize the position in real time, the way it optimized the strategy on paper, weeks earlier, in a calm room, with no money at risk. That impulse feels like diligence. It is actually your emotions hijacking your intelligence, using it as a tool to manufacture comfort, because the architect's analytical machinery, once activated under pressure, will always find a way to rationalize whatever action makes the discomfort of the moment go away. Think about what genuinely separates these two states. When the architect is building a system, there's no fear in the room, no pounding heart, no real-time consequence attached to being wrong in that exact instant. That absence of pressure is precisely what makes the architect's thinking trustworthy. It's operating on data and logic, uncontaminated by the nervous system's need to protect itself right now. The moment a position goes live and money is actually exposed, that protection instinct switches on, and it will hijack any cognitive tool available to reduce its own discomfort, intelligence very much included. An intelligent mind under threat doesn't stop reasoning. It reasons brilliantly, fluently, convincingly, toward whatever conclusion makes the fear go away. That's what makes this so much more dangerous for smart traders than for average ones. A less analytical mind, under the same pressure, might just feel scared and freeze. An analytical mind under pressure builds you an airtight, false permission slip. Here's how you actually apply this distinction, because stating it isn't enough. You have to build a hard boundary between the two roles. The architect's entire job happens before the trade exists. Map out the if this, then that parameters completely, exactly what triggers an entry, exactly what triggers an exit, exactly what invalidates the thesis, exactly how much capital is at risk. All of that work gets finished before a single dollar is committed. Once the trade goes live, the architect's shift is over. What takes over from that point forward is the soldier. A version of you with no opinions, no creativity, no authority to renegotiate anything. The soldier's only function is executing exactly what was already decided, regardless of what the analytical mind starts whispering once the position is exposed to real risk. I built rules simple enough that a child could follow them, specifically because I couldn't trust myself to follow complicated ones under pressure. If this, then that. No exceptions. No, but this time is different. And I can tell you honestly that the hardest thing I ever trained myself to do wasn't building better analysis. It was staying silent, as the architect, while the soldier executed a plan that my analytical mind was actively screaming was wrong in the moment. Some of the most profitable stretches of my career came from trades where every instinct told me I was making a mistake by following the system, and I followed it anyway, and it worked. Not because my analysis was suddenly worse than usual, but because I finally let the right version of myself make the decision at the right time. Once you can genuinely hold that separation, architect before, soldier during, you're ready for the trap that catches even traders who've mastered everything up to this point. Because it doesn't come from acting too soon or holding on too long. It comes from something intelligence prizes above almost everything else. And that's exactly what makes it so dangerous. The fatal hunt for certainty is the pattern that quietly undoes traders who think they've already solved the discipline problem, because it doesn't look like a mistake in the moment. It looks like conviction, and conviction is something intelligent people have spent their entire lives being taught to trust. Here's what makes this trap so specific to intelligent traders. An analytical mind is built to seek resolution. It gathers data, weighs it, and arrives at conclusions. And the entire process is oriented toward eliminating ambiguity, because ambiguity, in most of life, is a problem to be solved rather than a condition to be tolerated. The market doesn't operate that way. It operates strictly on probability, never on certainty, and no amount of analytical brilliance changes that basic fact. But an intelligent mind, faced with genuine uncertainty, doesn't comfortably sit inside it the way it should. It keeps working the problem until it manufactures a feeling of certainty, whether or not the underlying situation has actually become any more certain. This shows up in two mirrored ways, and both of them are dangerous. The first is refusing to act at all without absolute confirmation, waiting for one more signal, one more piece of evidence, because the mind hasn't reached its manufactured threshold of certainty yet, even though the actual, valid setup has already appeared and started to move. The second, and this is the one that's cost me more money over the course of my career, is the opposite. Scaling a position up aggressively because it feels completely certain, because your analysis has assembled such a compelling case that hesitation starts to feel irrational. That feeling of total certainty is not a signal that you're right. It's a signal that you've stopped being appropriately afraid, and appropriate fear is one of the only things standing between you and catastrophic position sizing. I want you to sit with this specific idea, because it runs against everything intelligence trains you to believe. The moment you feel completely certain about a trade is very often the moment of maximum danger, not maximum safety. Certainty makes you rigid. It removes your willingness to reconsider, to respect new information, to accept that you might be wrong before the damage becomes severe. Discipline, by contrast, keeps you flexible, because discipline was never built on the premise that you knew the outcome in advance. It was built on the premise that you didn't, and that your job was to manage that not knowing intelligently rather than resolve it prematurely. The application here is uncomfortable, and it should be. You have to train yourself to execute valid setups even when your intelligent mind is actively uncomfortable with the uncertainty involved. Because if you only pull the trigger once you feel fully certain, you'll consistently be entering too late, after the move that actually mattered has already happened, chasing confirmation that was never the point. Some of my most profitable trades came while I felt genuinely uneasy, watching a position I was intellectually convinced was wrong, and following the system anyway, because the system doesn't need my certainty to function correctly. It only needs my obedience. And obedience, it turns out, is something you can actually measure, track, and improve. Which brings us to the final piece of this framework, the one that ties every other point together into something you can actually act on this week, not just understand intellectually. The execution-driven loss journal is the practical tool that finally made all of this visible to me, because up until I started keeping one, I genuinely believed my losses were coming from bad luck and difficult market conditions. They weren't. They were coming from me. Here's the distinction this tool is built around, and it's a distinction most trading journals completely miss. A standard trading journal tracks outcomes: entry price, exit price, profit or loss, maybe a note about market conditions. That's useful, but it misses the actual disease entirely, because it treats every loss as the same category of event. It isn't. There's a fundamental difference between a technical loss, one where you followed your system exactly as designed, and the system simply produced a losing trade, because every system produces losing trades, and an intelligence-driven loss, where you overrode your own rules because your analytical mind constructed a convincing reason to do so. Technical losses are the routine, expected cost of doing business. Intelligence-driven losses are the ones actually bleeding your account dry, and a standard journal doesn't separate the two. So build a separate one, a rule-breaking journal, distinct from your regular trading log. Every single time you deviate from your system, moving a stop, entering early, ignoring a signal, sizing up because you felt certain, write it down immediately. While the reasoning is still fresh, write down exactly what rule you broke. Write down the precise narrative your intelligent mind constructed to justify breaking it, in your own words, as close to verbatim as you can capture. And write down the financial result once the trade is closed. Here's why this specific practice works, and why it works faster than almost anything else in this framework. Reviewing that journal weekly does something your memory alone can't do. It exposes the pattern. In the moment, every single rationalization feels unique, feels specific to that particular trade, that particular piece of information, that particular market condition. But laid out on paper, week after week, you start to see that your intelligence is running the same handful of manipulations over and over, with different market details plugged in each time. Once you can see the pattern in black and white, it becomes dramatically harder for your mind to sell you the same story the next time, because you've already caught it in the act, in writing, more than once. I once held a position in steel stocks for 3 months longer than my system allowed, purely because my analysis was, by every honest measure, excellent. Everything about the fundamental case was sound. The market simply wasn't confirming it yet. My system told me plainly, no confirmation, no position, exit and wait for a cleaner signal. My intelligence told me I'd already done the work, that confirmation was inevitable, that abandoning a well-researched thesis this late would be foolish. I stayed in. I watched capital sit idle for 3 months while other opportunities passed me by. And months after I finally gave up and exited, the move I'd been waiting for actually happened. Except by then I'd missed it entirely, because I was still recovering from the opportunity cost of being intelligently, patiently, expensively wrong. Had I kept a rule-breaking journal at the time, I would have recognized that exact pattern from a dozen previous instances, and I would have exited on schedule instead of trusting the story one more time. Put all 6 of these pieces together, and what you end up with isn't a strategy in the way most people define the word. It's a containment system, built specifically to hold something powerful and genuinely dangerous, which is your own intelligence, operating unsupervised. Reset your ego after impossible predictions instead of expanding it. Recognize intelligent exceptions as impatience in disguise and refuse to act on them. Treat your own airtight narratives as worthless the moment price contradicts them. Separate the architect from the soldier completely, and never let one operate during the other's shift. Distrust certainty specifically because it feels so good, and track your rule-breaking with the same seriousness you'd track your actual trades, because that's where the real account damage has been hiding the entire time. None of this makes you less intelligent. It makes your intelligence useful in exactly the one place it belongs, before the trade exists, and silent everywhere else. The market has never once been impressed by how smart you are. It only responds to whether you can follow the plan you built when you were calm, once you're no longer calm at all. That single ability, more than any insight, any prediction, any brilliant thesis, is the entire difference between the traders who compound their intelligence into a career and the traders who spend that same intelligence, one convincing exception at a time, until there's nothing left to spend. You came into this believing that intelligence was the advantage, that the sharper your analysis, the safer your money, the more certain your path to consistency. That's what every part of your life outside the market taught you to believe. You now know the opposite is closer to the truth. Intelligence didn't fail me 4 times because it was weak. It failed because it was strong enough to talk me out of the one thing that actually protects a trader: obedience to a plan built before the fear arrived. An impossible prediction isn't proof you've solved anything. It's an anomaly dressed up as identity. An intelligent exception isn't insight. It's impatience wearing a disguise good enough to fool the person constructing it. A brilliant narrative doesn't make a losing position safer to hold. Price was never listening to the story in the first place. The architect and the soldier are not the same person, and the moment you let them trade shifts, the soldier stops following orders. And certainty, the very thing your mind has spent a lifetime chasing, is often the clearest signal that you've stopped being appropriately afraid. None of this asks you to become less intelligent. It asks you to place that intelligence somewhere it can't hurt you. Before the trade, never during it. That's a smaller, quieter use of a sharp mind than you probably imagined for yourself. It's also the only version of it that survives. I spent 4 fortunes learning that the hard way. What you do with the 5th version of that lesson, the one I just handed you for free, is entirely up to you. If you'd rather not rebuild the containment system I just described from scratch, the rule-breaking journal, the pre-trade parameters, the post-loss protocol, the complete trading system already has it built out for you, 6 modules deep, down to the exact fields I described for tracking your own rationalizations before they cost you a 5th fortune. It's linked below. This has been Trader's Bible, the quiet room for market mastery.